Hello and welcome this week, everybody, to Middle Class Investor. This is Seth Martin. Well, we had an up week this week in the market. Let me zoom in a little bit and take a closer look. You can see here the S&P 500 finished at 2351.16, and we're now at the top of this channel. It's kind of by this line and by this line. And the reason I have two channels here, a bigger channel and then a smaller channel, is because this move in here is its own move inside this channel. So what does that mean? Well, what that means is we're likely to get a pullback here soon. It'll probably be inside this channel, maybe to the midpoint and then a little higher. And then later on, maybe mid-month, next month or so, we'll get a larger pullback within this larger channel, probably, definitely above here. So it won't go back this far. It won't go back to 2200, but it'll, in fact, if it does, then we're probably not going to get any high if it breaks through here. So, but I'm expecting it to go to this 2260 area and then rally up and make a new high up into here. So probably 2400, that's 2425, somewhere around in there. So if you've been wanting to get in, now the key is here, probably just beyond these highs. We should see some sort of topping process after this, and I'll show you why here in a little while when I pull up another chart. But let's take a look at the VIX. As you might expect, the VIX is still low because the S&P and the Dow are relatively high, and the VIX it's been trading below this red line here for a while now, several weeks. And I've said it before, but the saying, as the VIX is low, it's time to go. Now, of course, when's the time to go, right? Is it here? Is it here, here? So if you'd have gone here, obviously you missed out on a lot of upside. The VIX is not it doesn't, it's more like an oscillator, okay? So it doesn't really tell you anything about the trend. It just tells you about mood and complacency or fear in the market. And when the VIX is low, that just means there's a lot of complacency. People aren't worried about stocks going lower. Money continues to flow and prices continue to get bid up. And so that's what that means when the VIX is low. When people are more fearful, they go out and they buy S&P index options, put options, and that usually drives the VIX higher. But as you can see, there's no fear really of the market going lower. And the market is such that, if the majority of people are moving one way, the market moves the other way. So this is why the VIX is useful to look at, because if the market's really high and the VIX is really low, usually that's setting the market up for some sort of sell-off. It just has a knack of doing that. So it has a knack of hurting you when you're complacent. All right, let's look at the 13-week Treasury. This is the one we look at to tell whether the Fed is raise or lower or whatever. And they've been above this red line for some time, and of course they raised. And it looks like this is about ready to make another leg up, which means they'll probably raise again. Inflation year over year was up 0.6%. It's actually officially above 2.3, which means it's really probably more like 5 or more. That tends to be the way these government statistics are. They tend to be, if it's negative, they tend to be underreported, and if it's positive, they tend to be overreported. But anyway, So let's look at, let's see, what should we look? Let's look at the 10-year Treasury yield. This is the market that I continue to be the most worried about. I just think there's a price to be paid with all this borrowing, and we haven't even begun to pay the price yet. So we had this run up. Looks like we've got some sort of correction going on here, and it could go all the way back into this area before it actually made a new leg up. But what I want to say about this is we broke the downtrend line. So let's back up and look at this. We had this downtrend line that was lasting a year and a half. We broke the downtrend line and started to move out. And sometimes you'll get a retest of this downtrend line and then move out. I don't know that we're going to get that much of a pullback. It might only pull back to just below 2% right here around this line, or maybe a little lower. That's why I have the box there. Or it might just fill the gap and then take off. But I don't think we're going to get a pullback all the way to this downtrend line. I think we're going to get one into this area here. So if we do, this is a good place to consider getting out of those bond funds. All right, let's look at Germany, Japan, and the UK. So Germany, has broken the downtrend line too, but the move out is not as strong. So this all looks pretty choppy and corrective in nature. It could be that this is kind of a 1-2, 1-2, and then we're going to move out, but we just have to wait and see. It seems like the rest of the world's markets have already kind of started moving down, even though the U.S. market has not. And my feeling is it's probably that way with Germany. Now Japan is doing a lot of quantitative easing and stuff like that, so they're devaluing the yen constantly, and so that's why this is, if the yen is in the denominator, then every time the yen goes down in value, the thing that's in the numerator goes up in value, right? So that's kind of what you're seeing with the Nikkei. UK, I think, is kind of where Germany is. I mean, I think it's already begun to sell off, and this looks very corrective. Probably might get up above here, around this 33.5 area, and then resume the downtrend. Let's take a look at. Let's go over to charts and look at the dollar. So the dollar's had a good run, had a pullback. Looks like it wants to make another run higher. I think that's the general consensus too, that the dollar's going to make a run higher. So, maybe up into here, maybe a 108 area before the dollar really begins to sell off and go the other direction. And if you look carefully, it kind of coincides with the euro moving in the opposite direction. So here's our euro, and you can see here that it's kind of already touched this little area, but it could very well go through here. In fact, I'm looking for it to be pretty bearish here. In fact, maybe as early as early next week. So I'm actually looking for shorts on the euro to at least go down to this 103.5 area. So and I might, depending on how it looks, I might try to let it run a little longer. So let's look at oil. Well, first of all, let's look at the yen, because we were talking about the yen and how, the Japanese are devaluing the yen. So let's look at the US dollar yen. well, I'll tell you what, let's look at the Euro JPY. So the Euro JPY, you've got the Euro US dollar going down, and you got the Euro JPY kind of trading sideways. But JPY, there's no mistake about it. The currency is being devalued. I think they're trying to get rid of this 200% debt to GDP that they've got. Their economy's been stagnating for, you know, literally decades now. So, you know, they're doing what governments do when the economies aren't working well. They devalue the currency. So anyway, oil's kind of climbing here, but it's also kind of slowing down or losing momentum, and a lot of chop here. And so it feels like to me that oil wants to top. Now it could be waiting to, you know, there's a gap right there that hasn't been filled, and maybe this shoots up, closes the gap, and then turns around and sells off. But oil, I don't think is going to travel much higher than where it is right now. It might shoot up intraday or intra-week into this area and then turn around and sell off. I think that's highly likely. Let's see, what could we look at here? Let's look at gold. Gold has been rallying for the last several weeks, and you know, we've talked about potential entries for gold, and we were talking about this area here a while back, a few weeks ago, and you know, gold just doesn't look like it's going to slow down probably until it, you know, gets into this resistance area, and then it's going to probably roll over and go, you know, substantially lower than even where it is right here. So we're looking at an ultimate target low of gold around 700. So clearly, if it comes back down to this 1044 area, that's not quite low enough. So just look for gold and silver to go lower longer term as the deflation starts to set in and starts to really erode cash and cash equivalents. All right, let's go over. I'm gonna look at NinjaTrader real quick because I've got a chart here that I think is interesting, and I want to show you what happens. So one of these things I follow is something called Elliott Wave, and I don't talk a lot about it because I don't want people to think. First of all, it's fairly controversial. Elliott Wave is. A lot of people say, it doesn't work, and blah 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 blah. But this is a monthly chart, so each one of these bars is a month, and what I've found to be pretty accurate is their longer term trend, and I could show you when I say trend, their forecast. So when they look at these really long term charts, they tend to be pretty right. The challenge with something like Elliott Wave is you have this 1, 2, 3, 4, 5 in the direction of the dominant trend, and then you've got a correction, which they call ABC, in the direction of counter trend. And so the challenge is, like, if you were like right here, this could be an A, B. So you could be thinking this is a C, and that's why these little trade signals set up here. Oh, this is a C, we're going to go lower, we're going to go lower, and it just keeps going higher, right? So, you got to be careful to make sure you have your risk covered and things like that. But what I look for is whenever I see one of these 5 waves, I just know we're getting close to the end of this particular trend. And so you might ask, okay, well, we're once a 1, 2, 3, 4, 5 happens, what's the risk here? So what I did is I clicked on a little button up here, and I'm going to click on this pivot right here, and it puts this box up called a decision point. And you'll notice on my charts I use these boxes too, and I kind of estimate where they are. So what tends to happen after you have a 5-wave move is you at least travel back to the beginning of the previous 4th wave. That's just a rule inside Elliott wave. And you can see here that that's around 1700 on the S&P 500. So not an insignificant loss of capital if that were to happen in your account. A pullback from 2300 to 1700 is a substantial move in the S&P market, and you will find that it will be a substantial move in your 401k account as well. So just be aware of this. This is something I'm going to be referring to on a shorter term basis when we look at charts in here. But to me, this is very important, super critical. This is a textbook, what they call impulse wave, 1, 2, 3, 4, 5 in the direction of the trend. So these work almost always. I mean, if you can sell short here, I mean, this is a good target where this blue box is. So it's just something I wanted to point out. I mean, I use this when I start to see bigger pictures. I want to make sure that I'm using something like Elliott wave, just because it helps. It does help see the bigger picture. So if you were to go to oil, for example, it takes a second to pull the data up. There it is. But you can kind of see right here with, if I click on this, if I see what this pattern is right here, and this is a monthly, is it monthly? Yeah, monthly chart as well. So you can see here that this was a 1, 2, 3, 4. So we're in some sort of wave 4 here, and after wave 4, you typically will make a wave 5 in the direction of the primary trend, and there's your wave 5. And so this is one of the reasons I've been calling for oil to go even lower than it was, and I can't remember the previous low, but it was. Let me pull up this chart. This is the continuous contract that I'm trying to pull up right now. The one that's actually on the page right now is old. It's not the right chart, so let me pull up a different chart. It's not that different from the correct chart, but it's a little bit different. So it'd just be better to pull up the accurate chart that goes with this, that goes with oil. So we're waiting for that to come up. Oil is also closely tied to the dollar, so you've got to really watch the dollar when you're watching something like oil too. So you can see here, if I click on this little button up here that you can't see out of the screen, and I click on this pivot, it's saying this is a wave 4. So we had a 1, 2, 3, 4, 5. So what happens is after wave 4 is complete, you'll get some sort of move back down to make a wave 5, which a good target is this decision point area. And you can see from this target, that's 2240 minimum on oil. So that's pretty low. So that's gonna shake some people up. You're gonna see some more consolidations in the oil business. You're gonna see some bankruptcies. The problems in the oil sector are not likely to be over. So if you're looking to go long oil, you might wait at least until we pull back to these old lows and maybe just slightly lower, and then kind of push a bunch of money into your oil positions. Let's see, what else do I have? Let me see if I've got any other. No, that's really about it. I was looking to see if there were any other market, if there were other companies that we needed to look at their markets and see what was going on. The NQ, or the NASDAQ, which could be given by the QQQs, hold on, I'm pulling up the symbol, but I typed it in wrong. So hold on one second. There we go. So, one of the things that Elliott Wave was talking about is that the QQQ is actually ahead of the market in terms of its completion of a 5-wave move. So it's actually further along than the S&P and the Dow. So what you could see in the market is you could see the NASDAQ start to roll over, and then the Dow and the S&P sell off, but then, like I said earlier, turn around and make a new high in the Dow and S&P, and then the NASDAQ would just keep going lower. That's why I was showing you earlier from this chart. I was showing you, what it might look like, if you were to see how this pans out. You might see a pullback to there, then a rally, and then a pullback a little deeper, let's say to there, and then a rally. And then that would be about the end of 5 of 5 of 5 of 5 of 5. I mean, the size of the trend is very, very large. And I think the Elliott Wave stuff is good for that. So trading with it is a little bit more difficult unless you do something like trade it in isolation. And so what do I mean by that? This is a good example right here. We can zoom in on this. You can see that that from this high here down to this low, this kind of looks like an A, right? Then we rallied up, and then we rallied all the way back. So this looks like an ABC. It's also within parallel lines, which is typical of a correction. So, what I mean by isolation is just always look for this ABC kind of pullback, and then, enter when you get a signal. In this case, the signal could be a close above the high of this low day. So this is the low day. Here's the high of the low day. Clearly it closed. Now whether or not you buy here when it just pulls above the high, or if you buy up here when it closes above the high, it's kind of all the same. You just have to have your own rules, whatever your rules say. And those are the types of things we're going to be talking about in here when we start to see weakness show up in these markets. So if we start to see, sorry about that, hit the wrong button. If we start to see this market, start to sell off, boom, like this, and then like this, this is potentially a good entry for another up move, a move up into this area. You just have to watch it a lot closer. You can't just come in and check it every, once a day or something. You might have to check it a couple times throughout the day just to make sure you're getting the expectation. The market is moving in the direction of your expectation. All right, so what to look for next week? Well, we talked about that a little bit. We can talk about it a little bit more. I think you might see the market open up next week, so you might get a little higher, and then you get some pullback into here, and then a new high, and then we're going to see pretty substantial, compared to what we've been having down, is going to look like so, and then we're going to have one more rally to a new high. And I think this is a pretty feasible forecast, and we might see this might all take till the end of March or April before this all comes to fruition. It's probably right around the summertime. You're going to start seeing a pretty serious topping process happen in this market, and I think the forecast that EWI and others have put out is it's going to be pretty accurate. So, all right, everybody, that is about it for this week. I just wanted to put a little video together, see what we're seeing. We definitely have had a lot of strength. And we might even have some strength early next week, but before the end of the week is out, we should be pulling back a little bit to find some support pretty high in this trend, and then maybe a new high a week or so later. All right, everybody. We'll talk to you next week. Thanks for checking in on the Middle Class Investor. Take care, everybody. Bye-bye.